If you think about capitalism, 100 years ago, it was very different, right? You had Carnegie, you had J.P. Morgan, you had players who'd buy big stakes in businesses. They were control shareholders. There was an owner on the board of directors. So capitalism over time has democratized, which I think is great for accessibility to the average man in terms of investing in the market. But you get rid of owners controlling companies. So we look for very high quality businesses, what we describe as simple, predictable, free cash flow generative, dominant businesses, a business that Warren Buffett would describe as having a moat around it, right? If you believe that the value of anything financial is the present value of the cash you can take out of it over its life, well, you need to know how much cash it's going to generate over its life. So business quality to us is the single most important criterion for determining what's interesting. Because if we can't predict the cash flows, we don't know what it's worth. If we don't know what it's worth, we can't invest. So we figure out what it's worth, figure out how good the business is, how predictable will this cash flows be from a railroad or a spirits company or a real estate company, a shopping mall business. And then we say, okay, well, where's it trading? And if there's a wide gap between price and value, you can buy it for 50 cents, it's worth $1.20, well, then we're going to take a hard look and try to understand why it trades at a deep discount. And once we understand the reasons, we decide, well, these things that we can solve. Or can we, in light of the situation, the circumstances, can we be influential in changing these levers that can cause this valuation discrepancy to narrow? And is this a business that, while we're causing the valuation discrepancy to narrow, we can also perhaps contribute to the valuation growing? If those things are true, we found something that looks quite interesting for us. One of the best investments we ever made, it took us 4 hours to do the work. It was during the financial crisis.
Which was that?
Wachovia Corporation.
Okay.
So I was on my BlackBerry eating breakfast at the Brooklyn Diner in front of my building, and there was a story went across the, Wall Street Journal headline, Reuters headline, excuse me, went across saying that Citigroup to acquire the Wachovia banking subsidiaries for $2 in Citigroup stock. Stock was halted. And this was kind of an interesting transaction because they were buying the subsidiaries for Citigroup stock. I figured, this is interesting. What happens to the holding company? So I went back to kind of went upstairs to the office and, cracked open the 10K and another member of the team, Mick McGuire, he and I worked on it. And what was interesting is the 1,000-page 10K of Wachovia Corporation, I think 900 pages were on the banking subsidiary. There was fewer than 100 pages on the holding company. Most of the people that we have on the investment team are people with more conventional backgrounds. Half the team worked at Blackstone in either private equity or investment banking. A few guys from Goldman Sachs. But I'm a big believer, I had internships in my life. And if I meet a great human being, I want to give some people who didn't go to Harvard Business School and didn't work at Goldman Sachs for 4 years, some exposure. So I met, at the beginning of Pershing, I met a guy named Oliver White, who I believe is one of the, he's become recognized as one of the top fly fishing guides in the world. Very smart, interesting guy, taught me fly fishing. And I said, look, if you're interested in business and you want to intern at, learn something about it, come work for me. And Oliver came and spent 18 months with us. You're taking a very outdoorsy guy and you're putting him in Manhattan, which is kind of an interesting thing. He didn't like that part of it. But he learned a ton about business, and then he left. He actually worked a lot on one of our proxy contest situations. In the Ceridian, we had a proxy contest. One of the issues was the CEO was using the corporate jet to do a lot of fly fishing junkets. So we were able to track that stuff through his network of fly fishermen. So it was useful in the proxy contest. Anyway, and Oliver left, I backed him to buy a fly fishing lodge, which is the Abaco Lodge in Abaco in the Bahamas. And it's like, a 20% unlevered return on capital, and he's done an unbelievable job managing it. And we hired a guy named Marius Adamski, who I met on the tennis court. Super talented guy, went to Wake Forest, top tennis player. And I offered him a job, and he's worked for us for the last couple of years. And he did a lot of the research on Herbalife, and he did a phenomenal job. So I just, he's going to go to business school because he needs more training to come back into the business. But I think it's taking a short position and going public with it is a pretty serious business. And I debated long and hard as to whether I wanted to do that again. I took a lot of heat for taking a big short position in MBIA,
yeah.
and sharing my thinking publicly about why I thought that 150 to 1 levered AAA rated institution guaranteeing subprime CDOs was not good for America and not good for your pocketbook, and could cause a financial crisis, by the way. And it took us a couple of years to get the regulators interested in taking a look at the accounting issues, reserving issues, and so on for the company. But I learned a lot about dealing with the regulatory community and also, now, a lot of headaches associated with it. In the case of Herbalife, I couldn't really believe, I came to the conclusion that how can this company really exist? How is it possible that a $4 billion revenue business with a $7 billion market cap is a pyramid scheme? But you know, how could Bernie Madoff have had $50 billion under management in a pyramid scheme? And I debated, do I want to go public with this? And you know, the first part of that analysis is, one, we've got to get to a level of certainty here that is higher than any other investment we've ever had, because again, to come out and say a company's effectively violating the law is a pretty serious accusation. We didn't want to do it on our own. You know, we hired one of the top law firms in the country who did 6 months worth of work and came to the same conclusion, and agreed to meet with regulators with us, which I think was an important part of our the work we did. But still, do I want to go public and take the heat? And the problem with short selling is it's still not accepted as a particularly well accepted as an American way of investing. There seems like something inherently shadowy or evil about short sellers. You look at some of the, you know, David Einhorn's call on Lehman, Jim Chanos. If Lehman had done a recapitalization in response to David Einhorn saying they had inadequate capital, Lehman would still exist. And I don't know exactly what if the course of the financial crisis. We've still had a financial crisis, but probably not as severe. Had MBIA, in effect, recapitalized when we pointed out the inadequacy of their capital, you know, municipal bondholders would have a better insurer. In the case of Herbalife, we concluded the risk reward was very attractive. We thought by virtue of sharing our thinking publicly, pyramid schemes rely on deception. They've got to recruit almost 2 million people a year to keep the scheme going, and a growing number to keep the scheme growing. It's harder to do that when there's tremendous visibility about the business model. The company's been forced to update its disclosures that it's now sending to its distributors, and in fact 88% of the distributors make nothing. They get no royalties from Herbalife. That's not a fact that they were willing to disclose publicly before. They've been forced to shut down some of this lead generation recruitment that happens on the internet, which is a completely, the way it's done by their distributors is, we believe, totally in violation of the law. So just by virtue of going public, we mitigate the risk of being short because it affects their ability to deceive people, it affects the fundamentals of the company, and that reduces the downside of being short, the stock price rising. And then we have the benefit of a potential regulatory
catalyst. But you would never guess that.
So that's the kind of thesis.
Right.
Now, did I think that a group of hedge fund managers would take the other side of the trade and try to, you know, orchestrate a short squeeze? No, I didn't think that. In fact, what I think is disappointing about that, and again, it doesn't bother me at all if someone takes the other side. Every investment we have, there's probably someone short, things that were long, or obviously long things that were short. That's how the markets work. What's sort of nice about the hedge fund industry is it was an industry where it was more a cooperative industry. I didn't view my people in the industry as competitors because we'd find value together. You know, ultimately, you know, you see partnerships in various investments. This was the first case where a lot of sniping going on between managers, which I think is just a negative for the industry. So look, it's not an easy thing to be a regulator. It's you know, it's a job where you don't get a lot of awards for being a regulator. Unfortunately, you get in trouble for missing things. You have limited resources, even though it's the government. They have limited budgets. Companies have, you know, lobbying organizations. They have influence, and they push on the margin to minimize regulation and oversight of their business. So they're forces fighting against regulators. It took us 18 months to do the work. We could spend an unlimited amount of money hiring the best lawyers in the country. We can put an unlimited amount of resources to figure things out. We could focus just on this one company, and we have no obligation to regulate the rest of the direct so-called multi-level marketing industry. We found one outlier. We spent all of our time and energy on it. We studied it, and it took us a very long time to get to a level of conviction and certainty that we felt comfortable going public. A regulator can't do that. They just don't have the resources to do that. And that's, you know, look, I think the answer is, well, first of all, I'm philanthropic generally. There is a taint associated with short selling. My experience with MBIA is every time we talked about or made a presentation about MBIA, people would say, oh, he only believes that because he's going to make a profit if the stock price goes down. And what's interesting is all day people go on CNBC and talk about stocks they like, and no one discredits them by virtue of the fact they're going to make a profit if it rises. But on the short selling side, there's something, at least some people perceive as inherently wrong with it. In the MBIA case, the stock basically went up for years. The credit spreads got tighter and tighter, and the AAA rating remained. Until one day I gave a presentation at, forgot which conference, and I said at the end of my presentation, I hereby commit to give away 100% of the profits that I personally make from this investment. That was the high for the stock. It went straight down. The credit spreads went from 13 to 2,000. We made, a lot of money.
Yeah.
I seeded the Pershing Square Foundation with $140 million from that situation.
Fantastic.
And we've spent the money already, so we need to refill the foundation. So,
Yep.
in fact, we
There
spent
you go.
$200 million on charitable things, and we're running out of resources.
Yep.